Hello, this is Jan 2020 Part B question has to be answered. We have already solved Part A question, which was pertaining to the errors and journal entry for correction. Now we have to solve the next Part B, starting from the additional information at 31st December 2019. But let's adjust the errors first. The purchase returns and purchase return has to be adjusted. Purchase returns and trade payables has to be adjusted. So let's do that. So purchase returns I will have to add 1800, and from trade payables, that is global ICT was a trade payable, I will have to subtract 1800 because it was returned, okay, from the total purchases. So from the total trade payables, I will have to subtract the returns. Now the 2300 plus 1800, it is equal to 22,100, and the trade payables is 28,350 minus 1800, that is equal to 26,550. Then the drawings and the wages has to be adjusted. So you remove from the wages of around 900, and I have to adjust the drawings. I have to add the drawings. For 900, so plus 22,000 plus 900, that is equal to 22,900. And next, the third adjustment we have to do. The third adjustment is for the bank and cash and electricity and water. For electricity and water, I will have to add 2,300. 9,700 plus 2,300, that is going to be around 12,000. Yeah, just calculating. It's 12,000. And then bank and cash has to be adjusted. 10,350 minus 2,300, that is equal to around 8050. So this is bank and cash debit is current asset, but we can discuss this in the financial position. Now the second part B of the question is only to do with statement of profit loss and other comprehensive income for the year. So let's adjust other things. This inventory 5100 on 31st December is a closing inventory. Then he says wages were accrued 3,700. So let's adjust the wages. 4,800 plus 3,700 minus 900, that is 43,600. The next is advertising expenses include 4,000 payment for the campaign running from November to March. So let's write the months it was spent for. So it was spent for November, December, January, February and March. It was spent for 5 months. But we see that the closing is happening in December, which means this year's expenses only November and December, which was spent for November and December, has to be considered. Whereas the one that was paid for Jan, Feb, March is considered as prepaid expense. It will become prepaid expense, which we have to subtract from advertising expense. Now let's calculate 4,000, and out of that 2/5 is only for towards this year's expense, which is around 1,600. Whereas 4,000 minus 1,600, which is equal to 2,400, or 4,000 times 3/5 is also equal to 2,400. This is a prepaid expense and we have to remove it from the advertising expenses which was given, because it had included for the prepaid expense also. So we have to account for this year's expense. So 7,000 minus 4,000 plus 1,600, or 17,000 minus 2,400 is also the correct way of writing. 14,600 is this year's expense, advertising expense. So I'm writing here, it is 17,000, remove that 4,000 which was paid and just add this year's expense. That is one way of doing. Or we can just remove the prepaid expense that was included in the advertising expense. Of total 17,000 minus 2,400. That is equal to 14,600. Next we have to calculate the 5% bank loan which was taken out in 1st Jan. Half of it is to be repayable. So if the half is going to be repayable, it means that it becomes a current liability in this year. So 60,000 minus divided by 2, that is equal to 30,000, becomes current liability. This we have to include in the statement of financial position as a current liability. Now let's write the bank loan interest paid. 5% of 60,000 is equal to 3,000. So this is the bank loan that needs to be paid this year. But as we see, they have paid only 1,700 bank loan interest. So the rest is accrued, is considered as accrued. So 1,700 plus 1,300, that is equal to 3,000 is the expense, bank interest expense, out of which 1,300 is an accrued expense, which we'll account for in the statement of financial position. The next one is depreciation charges. Let's calculate the depreciation charges. Premises at the rate of 2% per annum on the cost. So 2% on 80,000 is equal to 1,600. computers and equipments. These are depreciation charges calculated by reducing balance method using 25%. So 25% times cost minus accumulated depreciation. So let's calculate that. 25% times cost is 30,000 minus 14,000, that is equal to 4,000. That's the depreciation expense. Then the third one is fixtures and fittings at the rate of 15% per annum using straight line method. So 15% of the cost we have to calculate. So 15% of 16,000, that is equal to 2,400, which is the depreciation charge for fixtures and fittings. And then we have the next is a debt of 2,500 is considered as irrecoverable. So let's write this irrecoverable debt as an expense, which we have to include in the profit loss statement. So irrecoverable debts, so this will become an expense. It is around 2,500. Now we have to also subtract this debt from the trade receivables. 37,500 minus 2,500, that is equal to 35,000. Now let's calculate allowance for irrecoverable debt. It has increased or decreased, we have to find. They are maintaining at 4% of trade receivables. So 4% of 35,000 is equal to 1,400. So there is an increase in allowance expense of around 800. Now Raj maintains a fixed capital account and all drawings and profit appropriations are made through his current account. This will include in financial position. Now let's calculate statement of profit and loss and comprehensive income for the year 31st December 2019 for the Raj, the retailer. So this statement will include revenue, cost of sales, then gross profit and expenses and profit for the year. So let's start off with revenue. I'm going to divide into 3 columns before starting. First one is the revenue. The revenue seems to have no adjustments and it is around 309,000. So I'm just going to write that revenue 309,000 pounds. So then next one is opening inventory, that is around 37,600. I'm going to write that. It has no adjustment, so I'm going to write 37,600. Then next we have purchases minus purchase returns. Purchases I had adjusted. Purchases around 216,000. Purchases account has only cash and credit purchases. So it is already given and there is no adjustments towards that. So it is around 216,000 less purchase returns we have to do. Here there was changes and errors. So we have adjusted it. So the purchase returns is around 22,100. And then we have closing inventory, which is given in the additional information. The closing inventory was around 51,100. Now first let's do the this opening inventory plus purchases minus purchase returns. What is the value? Let's calculate that cost. It is around 231,500 minus that closing inventory. So I will get the cost of sales. Cost of sales is around 180,400. It is around 180,400. This I have to subtract to get the gross profit. So I'll have to subtract from cost of sales 231,500 minus 51,100, that is 180,40. Now the revenue minus cost of sales will give me gross profit. So let's write that. It is around 128,600. The next one I have to calculate is all the expenses that has occurred. So let's calculate the expenses. The first one I'm going to put is the depreciation charges. So let's write the depreciation expenses for this year. So the depreciation expenses for the three non-current assets are as follows. First one is the premises. So we have already calculated the depreciation charges. Then the second one is computers and equipment. And the third one is fixtures and fittings. So the first one, the charge is around 1,600. So it is 2% of 80,000, which is 1,600. So we have to just write that. So let's write here the expenses. which is 1600, then 4000 and 2400. So write it in this column. Then the next expense is the wages. The wages is around 43,600. We have already included it. We have adjusted it for the errors that had happened. It's around 43,600. Then we have management salaries. There has been no adjustment or errors in this. So we just calculate and write it as 25,000. And the next is going to be electricity and water. This also had adjustments and errors, so we have adjusted it, and this is around 12,000. Then we have premises running expenses. This is around 6,900. It doesn't have any adjustment, so I'm going to write just like that, 6,900. Then we have the advertising expenses. This also had adjustments, so it is around 14,600. So let's include advertising expenses. The next one is the bank loan interest paid. That is around 3,000 for this year. That is the expense. So we just include just like that. So we have already calculated that. Bank loan interest is around 3,000. Then you have the allowance for irrecoverable debts. We will include, I'll just paste it here so that the working can be retrieved later. So bank loan interest paid is around 3,000. It's an expense for this year, and out of it 1,300 is accrued. It is owed. It's an owed expense. It becomes current liability. Then you have the irrecoverable debt expense. That is around 2,500. It is around 2,500. And then finally you have allowance for irrecoverable debt. The expenses for this year is around 800. It has been an increase from the previous 600. Now finally we have to calculate the profit for the year. The profit for the year will be revenue minus the gross profit. That is going to be my gross profit minus expenses. That is going to be my profit for the year. Sorry for that. So the profit for the year will be equal to 128,600 minus 116,400. That is around 12,200. So that is the profit for the year. Hi, today I'm solving Jan 2020, question number 1, B2 question, which is the statement of financial position at December 31st. The first portion, profit loss and journal entry and correction, has all been solved in the previous videos. So let's solve the statement of financial position. Let's prepare the statement of financial position for Raj, the retailer. The first one is going to be non-current assets carrying value. We have to calculate. So let's put all the non-current assets. We are going to calculate it from the cost, accumulated depreciation, and then the carrying value. The three non-current assets are premises, computer and equipment, and fixtures and fittings. So let's put them. So there is premises, computers and equipment, and then we have the fixtures and fittings. So the cost of each of them is given, the balances are given, and there is no adjustments towards those. So let's write the cost for all of them. The costs are around 80,000, 30,000 and 16,000. So the premises cost is 80,000. Then we have to calculate, we have to put even the accumulated depreciation. And the third column I'm going to prepare is carrying value of all these non-current assets, which is nothing but cost minus accumulated depreciation. Let's put the cost for premises. The total cost of all the premises is around 80,000 pounds. Then we have the computer and equipment costs around 30,000 pounds. And then we have the fixtures and fittings to be around 16,000 pounds. Now the depreciation for this year has already been calculated in the previous video. This was done because it was given in the additional information. These are 2% of 80,000, 25% of 30,000 minus 14,000 and 15% of 16,000 are all the depreciation costs for this year. So this was not included in the earlier balance in the provisions for depreciation, so we had to calculate. So this was the information given in the additional information. So we have to calculate and then adjust the total accumulated depreciation. Now the accumulated depreciations 22,000 plus 1,600 is 23,600. Then we have the computer equipment, which was 14,000 plus this year's depreciation of 4,000 will give us 18,000. And then fixtures and fittings, which was around 9,600 plus 2,400 will give me 12,000. So these are the total accumulated depreciation costs for the non-current assets. Let's put it in the answer sheet. 23,600 was for the premises, and then for the computer and equipment it was around 18,000. And then fixtures and fittings were around 12,000. Now let's calculate the carrying value of each of them. So the premises is going to be 80,000 minus 23,600. So the value is going to be around 56,400. Then we have the computer and equipment. Cost minus accumulated depreciation, 30,000 minus 18,000. This is going to give me around 120, 12,000. It is going to give me around 12,000. Then we have 16,000 minus 12,000. That is going to give me around 4,000. So now let us calculate the total values for the cost, the total accumulated depreciation of all the assets, and the total carrying value of all the assets. So the total costs will be around 80,000 plus 30,000 plus 16,000. That is equal to be around 126,000. So the total cost is 126,000. Then we have the accumulated depreciation. Just add all the accumulated depreciation, 23,600 plus 18,000 plus 12,000. This is going to be around 53,600. Then we have the total carrying value. You have to add 56,400 plus 12,000 plus 4,000. That is going to be around 72,400. So this is the total non-current assets. Now let's calculate current assets total. Let's add up all the current assets we have. The current assets include inventory, trade receivables. That too we have to use the closing inventory. So that's the remaining current asset with us. So inventory, closing inventory. Then we have trade receivables, other receivables, and bank and cash. These become my current assets. So closing inventory is around 51,100. That I'm going to write first. So current assets are those which can be easily turned into liquid cash for the business. So closing inventory. Then we have the trade receivables. So they have to be adjusted for an irrecoverable debt that has happened after the balances were stated, 2,500. So this has already been adjusted in one of the previous videos where there was an error correction and income statement preparations. So trade receivables minus irrecoverable debts, 37,500 minus 2,500, that is going to be around 35,000. So let's put the trade receivables, that is with the business. Then we have the allowance for irrecoverable debt that has to be subtracted. So let's put the allowance for irrecoverable debt, and we have already calculated this was around 4% of the trade receivables. So 4% of 35,000 is going to be 1,400. So let's put, we have to subtract. Okay, let's put allowance for irrecoverable debts. Allowance for irrecoverable debts. So that will be around 1400 I have to subtract. Sorry about that. I have written allowance for trade receivables. It's allowance for irrecoverable debts less. I have to subtract that. But it's not allowance for trade receivables. It's allowance for irrecoverable debts. ID. Okay. And then we have the other receivables. Other receivables were around 2400. This was prepaid expense. So the prepaid expense can become other receivables. So there was a 5 months payment, and of the 4000, 2 months was paid for this year, but the rest 3 months had become prepaid, means you paid extra already. So it was a prepaid expense which becomes a current asset to the business. So it was around 2400. So let's put it in the balance sheet, in the statement of financial position. So prepaid expense becomes current asset. So this was around 2400, sorry, 2400. So this became other receivables. Then we have the bank and the cash. It was a debit balance, which means it is a current asset. If it was a credit balance, it indicates a bank overdraft and it becomes current liability. So for in this case, it was a debit balance and there was an adjustment of 2300 due to an error that had happened. So it was adjusted. So the bank and cash is now around 8050. So this was due to the error, third error, which was mentioned. So, and we have to account for that. This has already been solved in the journal entry and error correction of the part 1 question. So the bank and cash will be around 8050. Now let's add up these. So the inventory plus trade receivables less allowance for irrecoverable debt, that should be around so let's add up 100 plus 35,000 minus 1,400 first. So this value will be around 33,600. Then you add up 2,400 and 8050. So let me put it here. Okay. So when I add up 51,100 plus 35,000 minus 1,400, it comes up to 33,600. So this comes up to 33,600 plus 2,400 plus 8,050. That is going to be equal to 95,150. Now we have to find the total assets. So it is equal to current asset, total non-current asset at the carrying value plus the current assets. So the total of 72,400 plus 95,150 will be equal to So that is going to be around 167,550. You can enter in the calculator. So that is nothing but the total assets which we have got. Total non-current assets at the carrying value plus the current asset. That will be the total statement of financial position. Now let's proceed to the next part. We have to put capital plus profit and drawings. So let's put the capital. The capital has been given in the balance. It is just 80,000. There was no other capital introduced. So let's put it around 80,000. Capital will not include the bank loan. The bank loan will come under current and non-current liability. So let's put here capital alone. And next we have to include he maintains a fixed capital account. All drawings and profit appropriations are made through his current account. So let's put that in the current account. So his current account had already got a balance. So the first we have to put the current account, and we will start off with the current account balance which was given for the Raj. This was credit, so you start off with a positive balance. If it was a debit, you should start off with a negative balance. So it is a credit balance, so it is exactly, we have to write 6,700. If it was given DR, you should be writing negative, okay, as a negative amount. So the balance was around 6,700. Let's write that. So this is the balance that was given in the Raj current account, 6,700. So let's write the balance. Then we had already calculated net profit in the income statement. So it was done in the previous video. So the net profit was calculated around 12,200. So let's write net profit. So let's write the net profit. This was around 12,200. Next we have the drawings. The drawings was around 22,900. It was already adjusted because there was an error that had happened in the books that was mentioned. So this was also accounted or answered in the other video for error correction and journal entries. So the drawings made by Raj 900 had been posted to the wages account, so it was not included in this. So I'm going to get extra drawings. So 22,000 plus 900 should be 22,900. So that is what I'm writing here. Now let's calculate balance. Drawings have to be subtracted. So balance plus net profit minus the drawings will give me the current account balance. So if we see, we have a negative balance of 4,000. Let's put that. So the current account balance became a debit balance. So that's why it's showing 4,000 negative. So 6,700 plus 12,200 minus 22,900. So it has become a negative balance. Now let's add up capital minus this drawings. Usually you add up, if it was a positive value, you just add up capital and this balance, but because it's a negative, you just subtract 80,000 minus 4,000, that is equal to 76,000. Now let's proceed to the non-current liabilities. In the additional information, it has been given that 5% bank loan, half of it has to be paid this year, repayable loan. It is a repayable loan, half of which I have to pay off this year. So the remaining half will be paid in 2020. So the 5% bank loan that remains in the non-current liabilities will be just around 30,000, which is half of the 60,000 loan. So this was already calculated. This was also done in the previous video. So the 5%, half of the loan is repayable on 1st Jan 2020 and this remaining is going to be 2021. So that's why I'm going to write 30,000 will still be remaining as non-current liability. I still will have time to pay it, whereas my current liabilities are going to be this 5% loan, trade payables and other payables. So let's write that. First let's write trade payables. I have to pay within a year. So let's write that. So this also had to be accounted. 1,800 had to be accounted. So it is 26,550 because a purchase return had happened. So my trade payables will be 28,350 minus 1,800, that is 26,550. So that is what I'm supposed to pay. $550. It is just 26,550. Then I have to put the 5% bank loan. 5% bank loan is that becomes a current liability is around 30,000. So let's put that. The bank loan interest is an expense that has already been accounted. Only because I'm still have to pay half of the loan, I'm putting around 30,000 becomes a current liability. Now let's put the other payables. So one is 3,700 and the other one is the 1,300. So both are accrued expense and they need to be paid immediately. So bank loan interest still was owed expense or accrued expense. So it becomes other payables. So 1,300 becomes other payables. And also the wages were accrued. So this was 3,700. So that was also become other payables. It's a current liability. I need to pay within this time, within this year. accrued expense. So even the wages had become accrued. So I'm calling it as accrued expense, which is a current liability or it is an other payable. So let's add up these two and write. So let's write 26,550 plus 30,000 plus other payables. When I add up 3,700 plus 1,300, it is going to be equal to 5,000. So let's add up the total capital and liabilities. So when I add up 76,000 plus 30,000 plus 61,550, I'll be getting around 167,550. So this is Jan 2020 paper, question number 1C. I'm going to answer this. So here Raj is considering entering into a partnership with Paul from 1st Jan 2020. Paul runs a computer hardware business. Paul's books show a capital of 80,000, but this does not include goodwill worth 60,000. There is no goodwill in the business of Raj, and it is agreed that goodwill would not be maintained in the books of the proposed partnership. So, this is a partnership between Raj and Paul, and profit and losses in the proposed partnership would be shared as in the ratio Raj 2/5 and Paul 3/5. Calculate the amount of Raj's initial capital and Paul's initial capital if they decided to form a partnership. So let's prepare a capital account for Raj and Paul. So you put the debit and the credit. Now on the credit side, initially only Raj account was there, so I'm going to put that. But on the debit side, I'm going to have the two accounts. So one is Raj and the other one is Paul, because they have formed a partnership. So initially the capital in Raj's book, okay, initially the capital was initially in the Paul's book, okay, the capital was 80,000. The capital was 80,000. So because the goodwill was not there, okay, earlier, I'm going to first introduce the goodwill in his account. So goodwill amount is going to be 60,000. Okay. Now I have to remove the goodwill from here, because they don't want the goodwill removal. Okay, this is goodwill removed. So when I remove the goodwill, I will remove it in the ratio of 2/5 and 3/5. Okay, so how will 2/5 of 160,000? Let's calculate. 2/5 of 60,000, not 160. It is 60,000. So goodwill of 2/5 of 60,000 is going to be equal to, so that is around 24,000. So this is around 24,000, and 3/5 of 60,000 is going to be around 36,000. So let's remove those two goodwill here. Okay, so this removal is put on the debit side in the capital account. So for the Raj it's 24,000, and for the Paul it is 36,000. So let's adjust the capital here. Now this is going to be balance C/D. Okay, the balance is going to be 80 minus 24, so that is going to be around 56,000. 56,000, and the Paul, it's going to be 140 minus 36, 140,000 minus 36. Okay, that is equal to 104,000. So 104,000. So let's put that. So the balance BD. So let's put the totals here. The total is around 80,000. Sorry, 80,000 for Raj, and 140,000. 140,000. So for Paul, so the balance BD remaining is going to be 56,000 and 104,000. So this is a capital adjusted. So they are asking calculate the amount of Raj's initial capital and Paul's initial capital if they decide to form a partnership. Okay, these are the workings. So let me put under the workings. These are workings. So this is the adjusted capital. So the answer is the amount that they decide to form is going to be equal to, so the amount of Raj's initial capital is going to be equal to the amount of Raj's initial capital is going to be equal to 56,000 and Paul, it is equal to 104,000 pounds. Okay.